Welcome to Revere Asset Management's Your Money with Danny Stewart.
The market will always overshoot to the downside and to the upside.
And Don Vandenbord.
Because it's not how much you make in the markets, it's how much of that you can keep.
Assimilation, assimilation, assimilation is making me wait. But you don't have to if you have Revere. Folks, welcome to Your Money Radio. We're Revere Asset Management. We're the most transparent advisor on the planet that I'm aware of, and we show you exactly what we're doing in our own portfolios, and we show you what the markets are doing every day in a daily market video, and then on this weekend podcast. We do it Friday morning. If you go on YouTube, you'll get it right away. But not only that, our money, Don and my money, the principal's money, Don and Ted, Connor and Ted and Todd, all the guys, all the team, all the portfolio managers and all the advisors here, our portfolio, we have money in these portfolios. In fact, Don and I, all of our money is, except for, gold, physical or real estate or something, but all of our paper assets are in these strategies. So you would actually have the exact same timestamp and stock, your portfolio, down to the percentage of each security in there, as well as the performance tracking would match Don and I's exactly. Except we're gross, you're net, because we don't charge ourselves a management fee. But other than that, there are no conflicts of interest, and you want all, so you think we're not watching these portfolios like a hawk all the time? Because it's not just your money, it's my money too? And our advisors, when the markets are open, they're glued to the portfolio, the monitors. They're watching your money. They're not out asking you for a tea time playing golf. What's your advisor doing during market hours? Anyway, just a thought. But the reason I brought that I think Carol King, I think she wrote that to homage to Carol. She's awesome. I think Sweet Baby James actually made it famous. But anyway, it doesn't matter. The assimilation process, because we talk about this about once a year on the podcast, and it's been a while, probably been a couple of years actually, and we wanted to refresh that because I have a client coming on board, has a decent amount of money, just retiring, big lump sum 401k, and she's scared to death and saying, can you please tell Don just to put it in a couple different tranches, maybe a little this week and then next week or the week after. I just don't want a 10% pullback. I think the market's going to pull back 10%. She said, I think that's first of all, if an advisor says, I think, those are the two most dangerous words in investing. Because Revere, price is truth, no exceptions, period. Every security's got to earn its way onto our portfolio, and then every security has to continue to earn its way on our portfolio. There is no pre-selecting stocks. And if it's not time to get in the market, we won't go in. But anyway, I kind of said, well, you got to let Don do what he does because we defend our returns judiciously. So not only do we not let clients pick individual stocks and put stuff in there, it's all our stuff, but when it's time to buy, we got to get in because, anyway, so we kind of went back and forth a little bit because she was scared, and I get that. By the way, if you're not scared, you don't understand the deal. I'm scared enough for both of us, right? That's why I watch the markets and not playing golf during market hours. Anyway, so now I called Don and I said, look, this new client's worried about it. Can we do it? And he goes, Danny, you got to explain it better than that because we normally go in literally 4 or 5 tranches. We do it very judiciously at the very beginning for the very reason that you don't want to start off with a client with a 10% pullback right away. You got to get them in judiciously. So when a client comes in with lots of stocks, first thing we do is we go down the list, dog, sell. A couple that look good. We'll actually, now when I say trailing stop, that's philosophical. We use we use an alert because if you're using hard stops, a conditional order, the market makers know what those are and they rate retail investors all the time. So we don't actually use hard stops, but I'll use that as a term. So we'll put trailing stops on the positions that they have that look good. Then we go to ours. Buy this. These 3 are on profit watch. We can't do that. This one maybe gets stopped out. So we start them off just with what we have, and then we go from there. But if you have all cash in right now, how do you do that? How do you get in when you're either because she's saying, the market's at all-time highs, I'm scared. Market is all-time highs. So how do you enter? How do you navigate that? Right? Remember, Bill O'Neill used to say, I want to buy high and sell higher. He loves stocks at 52-week highs or even all-time highs because there's no overhead. We'll explain that in a minute. But I want you to understand, because a lot of clients are going, ooh, I want to come to Revere after the pullback. They want to wait for the pullback. Folks, any time's a good time to come to Revere. But the best time to come to Revere is before the next bear market. Because we specialize in buying too. We got buy rules and sell rules, but we specialize in selling. Clients pay us to sell. Do you have a sell discipline? If you have a fiduciary advisor that requires $500,000 on TV all the time, they do better when you do better. Ask them what their sell discipline is. Ask them. Ask them what the levels are in each position in their portfolio. They don't have them. Okay. Now, why do brokers or other advisors, why do people have that feeling that all of a sudden Revere's just going to go in and just buy everything at once? Because that's what happens on Wall Street. You see, they don't get paid unless you own their stuff. See, it's not your money. It's their money. They take your money, they spread it out. They spread it out in emerging markets, muni bonds, treasuries, tech stocks, and they make it their money and spread it out amongst their clients. They're an investment banking firm. That's why they tell you that. So when it comes on board at somewhere else, anywhere, just about anywhere else, whether it's, well, I'm not going to name names, just put a name to it. You'll know them, any of them, right? They liquidate all your stuff and they buy all their stuff right away. They're diversification. They're rotten fruit as well as a good fruit for a diversified, balanced diet. You don't want rotten stocks, but they give you rotten stocks along with good stocks. We don't do that. We meticulously get you in to the markets. So we're going to go to that now. Don's going to be out this week, and I think actually next week too. He's watching the markets from afar. These guys can't help it, but he's taking a little R&R with his computer. He never leaves home without it, right? So Teddy Bull is going to do the market update, and then Connor is going to actually do a deeper dive into the assimilation process that I just spoke of. And then Todd is going to talk about a few big setups. And before I forget, Don has actually been invited. He's going to be a speaker at the Trader Lion Conference in, I don't know the date, I'm guessing July. It's either June or late June or later this month. I think it's July. But anyway, Ted will probably know.
Yeah, it's in July.
July. Anyway, all right. So don't miss that. Yep. That's an online virtual conference. It's awesome. I think it's all weekend. It's pretty long. They got some big hitters in there. They got some big names. So in any event, without further ado, Teddy Bull, what are the markets telling us? What is price telling us that what's the market's truth? Ooh, that's a good one. What's the market's truth?
So we've definitely seen some volatility over the past few weeks. And like you mentioned, having rules is critical, buy and sell rules, because it prevents you from making emotional mistakes. And today I'll show the intraday action in a little bit, but it's been quite volatile just on some news events. And as you guys may be well aware, there's the Israel-Iran conflict in the last couple of weeks. We had FOMC this past Wednesday, and today we had some US-Chinese chip restriction news. And so far, we've made this V-shaped recovery off the lows quite nicely. We built out this mini handle, which we broke out of, and we pushed out above 6,000. But so far, we are struggling around the 6,000 level. I'm going to zoom into the intraday and draw a line around 6,000 and see for the past about like 10, 11 days, we poke our heads above 6,000 and then we get smashed down. Poke our heads above 6,000 and we get hit down again. Once again, today, popped above 6,000 and smashed down so far. So this 6,000 level continues to remain a key level, as well as 6,100, which was pretty much the previous all-time high. And it just makes sense that after nearly a 20% crash and then a 25% recovery, we do need to build out a right side just to bring out some supply, especially on this left side here. You can see we're approaching that area. So this zone, this box right here, remains the key area that we are watching. And right now you can see we are building a right side, another higher handle here, still above the 21 EMA, although the slope of the 21 EMA is starting to flatten. And that tells us that momentum is starting to wane. That's what we've kind of seen in the price action and the tape in the last few weeks as well, with some distribution days piling up. And again, distribution days are when the market closes greater than or down more than 0.3% on higher volume than the previous day. And so this would be an example right here, one right here, another one right here, another one yesterday. And we don't want to see a cluster of distribution days pile up as well as leaders weaken, and that would signal maybe a market pullback is on its way. For now, leaders still continue to act strong, and we're going to take the action of the leaders over the distribution days.
And
what we want to look for now is
the green's at 21 exponential, right?
Yeah,
right?
that's a 21. Yep. So right now, we definitely want to see the S&P 500 hold the 21 EMA. We are getting a little long in the tooth for typically for how long we see the S&P trend above the 21. I think we're about 39, 40 days above the 21 EMA now. So it wouldn't be abnormal action to have some shakeouts below, especially with the 50-day still quite far below, but the rate of acceleration of the 50-day is starting to steepen here. So sooner or later, it's going to catch up the price, and that'll definitely be a good sign. And just another thing to note, the black's the 200, the red's the 50. That golden cross that we talk about could come soon in the next few weeks, just like the death cross came just a couple months ago. So that's another thing we're looking for in the S&P 500. We want to hold this 59.68 level, which is pretty much coinciding with 21, and we want to break out above that level. We could potentially see resumed momentum if that happens. But one thing to note is we are heading into summer trading, and typically that is lower volume. Fund managers heading on to vacation, and there could just be more choppy action in the summer. Let's just quickly go over the NASDAQ. Commentary will be similar as well. A little more volatility since NASDAQ is tech heavy. And if we go on a 5-minute chart, you can see we pushed out in the morning and we had that news that the US might restrict chips. Just more trade tensions with China, and we had the sell-off, which we bought in around 11:05 a.m. Rallied off the low so far, but we want to see how we act here, whether this is just a lower high intraday and we head back to the lows, or we do hold here and see a good close. But this is an outside day reversal. You can see the highs are above yesterday's highs, tight day, and the lows are below yesterday's lows. That just shows expansion volatility, and that definitely makes our at least it's just a little flag that we are noted. You can see distribution days are also piling up in the NASDAQ as well as we approach previous all-time highs. So some flagging action. You can see pattern recognition has got this cup with handle as well. So maybe a shakeout with the 50 catching up, something like this, shakeout to the 50, reclaim the 21, and then perhaps we can break out into all-time highs as what we're looking for on the NASDAQ. And then quickly reviewing some small caps, the Russell 2000 index. So I'm going to use IWM because there's volume. The Russell 2000 doesn't have volume. Donna's talked about this. We rejected the 200-day moving average, and that was actually a potential good short opportunity. But we've held the 21 EMA and 210, which is a good sign. We just want to see this hold and get back above the 200-day moving average, which has been listed on our keys in the tail of the tape for the last few videos or last week. So overall, we're just monitoring the action of the leaders, still really strong leaders in various groups and themes like AI data centers, names like MBiz, CoreWeave, crypto as well now with the stablecoin news coming out the Senate where they're trying to figure out regulatory clarity. So you see Coinbase, let's just show the charts since I'm talking about them anyways. Coinbase and recent IPO Circle really just go parabolic. This is getting really extended, so we're watching for this to potentially cool down. The initial price of the IPO is at 31, and it's already 7x in less than 2 weeks, or in about 2 weeks. So this is some ridiculous action, clear optimism for stable coins and crypto infrastructure. So we're definitely paying attention closely. This is enormous strength. Same with coin as well. Enormous money has flowed into these two names. The nuclear names, the whole group is acting well. Names like OKLO, LEU, which we own in Turbo, SMR as well, BST, CEG. I'm not going to type those out since I just quickly listed them. But the groups are acting well, leaders are acting well. Indexes are seeing a little bit of stalling action. We're going to go with the leaders first, and yeah, we want to see these cup with handle breakouts. So that's a quick synopsis of the S&P 500, NASDAQ, and Russell. And that's it from me, Dan. Unless we want to cover some Bitcoin too.
All right. Well, yeah, go do Bitcoin real quick.
Bitcoin.
Everybody wants to know about Ted. Everybody wants to hear about Bitcoin now. It's the new gold, Ted. Come on. Giddy up.
So we'll talk about the IBIT ETF. I don't have the trading view prepared, so we won't get to the spot price, but IBIT will be sufficient. On the spot price, Bitcoin is right at the 50-day. IBIT, the 50-day is still aiming to catch up. So that's just one key difference there. But we are building higher lows. See, we had this low here, and we're building higher lows here. Still struggling against a 21. But what I see as a potential just flag or handle forming on this huge cup with handle. So that tells me this might be ready soon. Perhaps we compress a little longer, and we're ready for that breakout. And this level right here, 61.71, coincides with spot Bitcoin's price of about 109,000. That is a key level we're looking for. This area right here, this peak, coincides with Bitcoin's 111,000, and that is also another key area that we're watching for. Now, I know the mailbag, Dan, you said we're going to save Bitcoin for next week. You had two questions about some other two ways of playing MSTR. We will do more research on that and get back to you next week. But in terms of playing Bitcoin, this is probably your best pure way of playing Bitcoin. It's the Bitcoin ETF, tracks it nearly 1-to-1. If you want some juice on there, BITU is 2x leveraged, or BITX. Those are options. And of course, MSTR. But to us, MSTR is acting a little sick relative to Bitcoin. Bitcoin's almost near all-time highs, and MSTR is still far, far off all-time highs. I think 31% off the 52-week highs. So those are the ways to play Bitcoin. Of course, well, the direct ways to play Bitcoin. I mentioned Coin, which is another way to play the crypto space, and then Circle as well.
Yeah, and JP Morgan just announced they were going to support Coin,
Yeah, stable coins.
Yeah.
But warning here, though, these two are overextended on a short-term basis. Really, really overextended. So definitely don't chase right now.
All right. Thanks, Ted. That was awesome. All right. Now, what Ted was talking about, we get a mailbag. And folks, you go up to our website, revereasset.com, and up in the right-hand corner, there's a subscribe button. You can subscribe to our daily market newsletter they do every night. The market's open about 10 minutes, kind of what Ted did just now. And then we do the podcast. That'll come in every Saturday morning. But next that, there's a contact us button. So you can send me a question or a comment that you wanted on the show. And this is the mailbag. But by the way, before I forget, the show notes, there's no show notes this week. They were just kind of boring, and they were talking about Iran and Israel, or they were talking about tariffs. And it just, it doesn't help you. Price is truth. So I just didn't do it this week. But anyway, this is from the mailbag, and this is 6/18 a couple days ago. And this is from Trader I. I'll leave his last name out. Trader I. Hello, guys. Could you go over STRF and STRD on this week's Your Money podcast? Are either worth the invest for a portfolio for the yield? And what would be your strategy to purchase shares now? How does MSTR price affect these two? Is there a way to profit off Bitcoin and MSTR in price if they go higher? Thanks. Well, first of all, I'd say you just need to watch the charts on Bitcoin and MSTR and play them based on the charts. Don't play them based on a derivative. Now, STRF and STRD are these preferred shares, these special class shares that pay a 10% dividend, a 10% yield, theoretically in perpetuity. Folks, remember, yield. Now, we will do the research because we just got this yesterday, the day before, and we didn't have time to go look and see what the underlying security for the 10% yield is. But it's going to be based on the price of Bitcoin price. And so if Bitcoin takes a shellacking, I would assume that yield would go down, or the ability to pay might make investors nervous, and the stock price goes down. Because remember, if you got a 10% yield and you lost 30% on the stock, did you make money? No, you paid 10% on the yield, and now you have a 20% capital loss. So here's the deal. Look, I've got an accounting background. Todd here is a CPA, a former CPA. Look, I don't care whether you call it dividends, interest, income, capital gains. It's all about the net to you after fees and taxes. We don't worry about dividends. Dividends are it's an extra little gravy if we happen to get it, but price is truth. When it's time to buy, it's time to buy. When it's time to sell, it's time to sell, regardless of whether that stock has a dividend or not. We don't worry about dividends. We're not Growtection. has annualized around 12.5%, 13% with no bear markets ever. Why are you worried about a dividend? So you got a dividend portfolio making what, 7%? You got to lose 30% every 5 years? I don't want that. I don't care about the dividends. That's my take. Now, that's my opinion. It's a little outside the box, but we're an active manager that controls drawdown instead of that diversified pie chart lie charts story where you get a whole bunch of diversification. You got to write it down. You make 7%. We're doing something totally different. So that's different. Keep watching our podcast, but we will go over next week on what the actual security for those two things are. All right. With that, now we're going to go to Connor. And Connor, because we have not done this in a couple of years, man, if we make this good enough, this may actually could be a evergreen segment that we could post on YouTube for the assimilation process at Revere. So Connor, when a new client comes in, I want you to explain what we do, both if they've got a lot of stocks. I'm going to be politically correct. I got to be careful because anyway, a lot of stocks, or just cash. This one client we were talking about, she came in with a lot of cash. She was worried about how do we get in without getting stung right away. That's a great question. She had a great question. I like it. Right? I explained it poorly, and then when I called Don, and he clarified it. So I'm going to let Connor take it away. Connor, as the Beatles once said, "Don't let me down."
All righty. Thanks, Dan. Yeah, so the assimilation process, this is a question, one of the better questions that we get and a lot of clients ask when they're deciding to come on board. So like Dan mentioned, there's two different scenarios that we face. The first one is if someone transfers over an account with many different stocks. And so once that account comes over, our first order of business is looking at the charts and looking at the relative strength. And our main goal is to get them into the model portfolio, whether that be Growtection or Turbotection. So once we go through the holdings that they're coming in with, if the charts look bad, if they're below the 200-day moving average, it's a very easy sell. But on the other hand, sometimes people come in and they have good acting stocks, and there's no reason to sell it if they're acting good and they're going up, making the client money. So we will look to hold those for a certain period of time to capture that move before selling it off. Again, our main goal is always to get it 100% in line with Growtection or Turbotection, and this process can take a month and a half. It really depends on the market conditions. And so that's kind of the rundown of what we do if they're coming in with stocks. On the other hand is if they're coming in fully cash. And our two main objectives is, number one, is we don't want the client to have a drawdown from the start. And number two, if the market's going up, we want them to get exposure into the market as well. And so it can be a little bit tricky at times because sometimes clients come in when the market's near the highs, which is, like Dan mentioned, there's no bad time to come to Revere. That makes no difference. But what can be a little bit challenging is that we are trying to work in new capital into existing winners that have large percent gains. So, the people that have been in the portfolio for a couple months, they could be looking at a 50, 60% gain in one stock, while this new client's coming in with fully cash. So we're very methodical and we take it slow because a 5% pullback for someone that has 50% cushion is a lot different than a 5% pullback for someone that has no cushion. So it's a balancing act of taking it slow and making sure that using proper progressive exposure and getting these positions into the portfolio. They might be smaller size just due to the fact that the stock has ran up and is quite extended. In terms of the index exposure, it's a little bit easier, right? We can assimilate with the S&P using tighter stops with the 21, but really it's all about finding low risk entries into the individual stocks that the portfolios hold and taking it slow. There's no rush because, again, our main goal when a new client comes in is we do not want them to see a drawdown off the start, and that's always in the back of our mind, and that's what we're focusing on. And then two, again, if some of these stocks are providing low risk entries, then we can start to assimilate them into them, especially on pullbacks. And then it also always depends on market conditions. Someone can come in when the market's pulling back and we're getting stopped on some positions, and then there's that. So then there's less positions to assimilate. But for instance, right now, TurboTax, when we've had some new clients come in, and again, this rally's been strong. We have a lot of nice double-digit % gains in a lot of stocks, and we've been just using a combination of pullbacks into ascending moving averages, potentially just taking smaller size, and just being patient, waiting for the right entries. So that's a little bit on the assimilation process. Dan, do you want me to touch on anything else?
No, that's really good. So folks, what he's saying in plain English, when a client first comes in, we immediately look at the stocks we have, and a lot of them will be on profit watch. We're not going to go buy you a stock that we own because it's extended. You didn't get that when you missed it. You weren't here in time, right? Like I said, we're not the brokerage firm. We're not Wall Street. We just go buy everything we own right away. So we'll buy the few things that aren't extended and are still within buy range in your own personal account, in your specific, and then you're in the Grotection or TurboTax strategy, and then everything else is done at the block level. Any new buys, you get that same new buy. So you'll get assimilated over the next 2 weeks to 2 months, depending on the market action and the market feedback and what price is telling us. We don't just do it, boom, the first day. And we certainly don't rebalance on 1 out of 365 days just because that's the day we chose to rebalance. Folks, that's dumb. It's stupid. Sorry. I said it out loud.
And then
go ahead.
Just to touch on one more thing is that's what really separates Revere. Once you become a part of the family at Revere, we really care versus a big firm. Right from the get-go, you're just all in, regardless of the market condition, regardless of if the market's extended or in a risk-off period. So, it's part of the job that is very important and that we pay very close attention to.
Yeah, and so when a client comes in, when the clients come in, we have a daily meeting about an hour before the market opens. Everybody goes around the room. First thing we do is we talk about the new clients that need to be assimilated. So until they're fully assimilated, they're a separate group. They're treated with kid gloves, and they're actually brought in judiciously and carefully. And only once they're fully assimilated do they drop off that list. So they're talked about, and they're assigned. So Don's watching it and coordinating it, and then he either assigns Ted or Connor or Todd to assimilate that particular account with his blood. They go over it and they do it together. Okay. So it works very judiciously and it's very careful. So if you're worried about when to come on over, don't try to time it. Again, you're putting your emotional beliefs on the market. So like that woman coming on board, she feels like the market's going to go down 10%. Guess what? I feel that way too. I feel just like she does. Exactly. That's why I need rules, because I got to be supple enough in my mind to know the market could go up 10 or 20% from here, or it could go down 10 or 20% from here in the next 3 weeks. Either way, if you don't understand that, you're a rookie. You don't understand it. And I've got to follow price, and I got to follow what price is telling me quickly. But I know that I can get out if it turns around on me. That's the difference. I don't buy and hope. I don't stay in there. If it's wrong, we always say at Revere, it's okay to be wrong. It's not okay to stay wrong. Okay? That you'll be right enough times if you manage the wrong ones, and they're not wrong when you first buy them. They just the market changed character, the stock changed character. Given that same setup 2 weeks later, I'd take that same setup again. By the way, most rookies won't. They'll go, ooh, I lost money on that stock 2 weeks ago in a short. I got stopped out at 4 or 5%. I don't want to do that again. You're a rookie if you can't do that. If you can't get over your mind that you can buy that same stock again. I want to go over one more related topic about that, and that's legacy positions. We got people all the time that, they inherited a position from their father, and so they feel like their father that worked there at that company for 40 years cares about her and cares about her father and all that kind of stuff, and they love that stock, and it's either an oil stock or it's a tech, whatever it is. But that one stock, because they don't want to, in a taxable account, they don't want to pay the tax. So they think they're saving money. Folks, the tax is 20% capital gains long-term, that's it. But is that stock going to outperform the best of the best stocks? Most stocks go in waves. They'll do well for a couple of years and then they'll go out. So number one, you're going to make most likely, unless you got just a rock star winning stock, then you're going to hit a grand slam at the bottom of the ninth in the World Series. But if it's just an average stock, you're actually going to make much less return with a lot more risk because you got one big bet on one stock. So in other words, you sell that stock and you pay the capital gains. Now you spread it out over 5 or 6 stocks. So you spread out your risk during an uptrend, during a downtrend, we'll sell, and you'll actually most likely make higher. Within 2 years, you'll have more money. And yeah, you'll pay more tax. You will pay more tax, but you'll have more money to show for it. And you'll have less risk because you'll be able to control drawdown. So holding a legacy position because you feel some kind of loyalty, like that company cares about you, or just because you just don't want to pay the tax, folks, that's paying to be wrong. You're actually going to have less money at the end of the day, so you're paying to be wrong. So those are just something to think about. That's how we meticulously do that. Does your advisor sound like us? All right, Todd, we're going to go to Todd. We're going to talk about a few stocks that look like they may be gearing up or now down. We'll see. Todd?
Hey, Dan, thank you very much. And actually, I'm not going to give you 3 setups this week. I'm going to give you 3 situations. This is more of an educational segment today from my end.
Okay.
And I want to go back to the April 7th bottom and talk about 3 types of bottoming setups that occurred that were big shakeout type setups. And the 3 ones I want to talk about are the double bottom base pattern, which was very prevalent in this last bottom. Number 2, a 1 or 2 day shakeout pattern where we had a big reversal off the bottom, and then that proved to be the bottom, and many stocks went on from there. And the third type of shakeout pattern that really didn't occur so much in this last one, but I'm going to give you one example, is an inverse head and shoulder bottom. Okay? And why are these types of bottoms powerful? Well, number one, they're all shakeout mechanisms, shakeout and reversal mechanisms. Number 2, they show support confirmation. Okay? And number 3, they help define risk reward in a trade and or put a stock on your radar list for a potential setup after these have occurred. So let's go with one of the nicer double bottom type setups that we had. And that the first one I want to talk about is Spotify. All right, Spotify was a nice classic double bottom base setup into the April 7th bottom, going into the April 22nd follow through day.
Looks like a W.
And yeah, it's really a W type bottom, but in particular, the rules are you must have an uptrend going into the pattern, which we did. The second rule is you have a sharp sell-off from the highs, and then you have a rally that gets back in toward the upper end of that base, which we had here. And then we go on and we undercut the low of the first sell-off, okay, which we did here. And then from there, we can either take a position in a stock or wait for it to set up. Now, this particular one did not make for an easy entry. You can see on the breakout, it did come in and it had a retest and shake down to the 21-day moving average. Okay. However, it is a pattern that's very powerful and was very prevalent in this. And if we go on to one that did work nicely, NRG, Connor, or Ted, I'm sorry. NRG did go on and worked out very well. Okay. Now let's go on to a nice 1-day type shakeout or 2-day type shakeout. Snowflake. Okay. And I really like to see these nice cup bases with a big shakeout reversal bar right at the bottom of the cup. It just confirms a nice bottom is potentially in place. And Snowflake had a beautiful 2-3 day sell-off going into the lows, with a nice shakeout reversal on heavy volume where it closed at the highs and then quickly followed through and set up down the road. So again, you can buy these patterns if you want. We typically won't because, this was still below the 200-day when the reversal occurred. However, it definitely got on our radar screen as a stock to follow to look for a potential entry as the market developed.
And
so
as it clears the 200-day moving average, a black line.
Exactly. Right. And oftentimes we'll use some tightness followed by a pullback to the 21 EMA, which holds. Or if a stock is just extremely strong, we may use the 8 EMA as a potential entry point. This particular one took its time. Again, ended up being a nice earnings gap here, which is potentially viable now. But we saw a lot of these one-day type sell-offs occur with a nice shakeout into the bottom of the cup base. Now, finally, let's look at Robinhood too. Robinhood was kind of an in-between situation where it really wasn't a classic double bottom base because the rally after the first low did not really occur in the upper end of the base, but you did get that shakeout below the initial low. And we were able to take a position on this post-earnings on a successful hold of the 21 EMA here. And this is one of our more successful trades out of the follow-through day. But this was a nice double bottom style shakeout, although it's not registering and not a classic double bottom base. You did have that nice undercut and shakeout, which helped identify the risk reward in this trade. And finally, we did not get a lot of these, but I want to talk about the inverse head and shoulder, which is an extremely successful pattern. And let's go to the IWM or the Russell 2000 index. This one has a head and shoulder style bottom that has not successfully triggered. It didn't successfully test or break out of yet. Okay, there aren't too many inverse head and shoulders patterns in this last market sell-off because everything really went on to rip and move higher. And the Russell's still down pretty big on the year, so this is a setup that potentially may work if we can break through the 200-day moving average. But this is another nice shakeout reversal type pattern, and this is one of the better ones that I see potentially happening. And again, we hit the 200-day, failed, but we're riding along that 21 EMA, and a nice break above the of the 200-day could be a trigger of this inverse head and shoulder bottom. Again, I have several examples of these that we're not going to go through. If any of the listeners have any questions and want to contact me, I can go through about 10 different names with some really nice shakeout bottoms that occurred. And that's all I have today.
All right, Todd, thanks. So basically, folks, here's what Todd is saying in a nutshell. There are certain patterns that increase your probabilities. It makes your probabilities a lot higher when the market starts resuming an uptrend, when it starts rallying. It doesn't mean it's foolproof, doesn't mean it's perfect, but when those setups occur, you can take those, and then the ones that run, you feed those, you keep running, and the ones that don't work out, you stop out pretty quick. So you keep your losses to single digit and then let your winners run. I know you've heard that before, and it sounds easier said than done, but we've been showing you, the listeners, how to do that in the evening podcast all the time. Okay, so it's a law of large numbers. In fact, we'll buy 10, I'm just going to oversimplify. We'll buy about 10 stocks. 2 or 3 of them won't work out. We'll get down, have an 8% loss, 6% loss, 4% loss. And then we'll have a 2, 3 or 4, whatever that makes single digit or low double digit start to roll over. We get stopped out. And those will kind of offset these other. And then you'll have 2 or 3 that just run and make 20, 40, 50, 80, even sometimes over 100%. And the majority of your gains will come from 3 or 4 stocks. The lion's share of your gains now, if I knew which ones those were in advance, we wouldn't be having this podcast. I'd own Maui, right? I mean, seriously. So we're not clairvoyant, but what we do is we control the drawdown. That's how you control the drawdowns. That's how you don't get the rotten fruit. When the stocks start to turn around and the stock starts to turn rotten, we don't hold it. Everybody says, what stock do you like? Any stock that's going up, I like. I like the stocks that are going up more. I don't like stocks that are going down. Any stock that's going down fast is evil. So it doesn't matter about your risk tolerance is not as important as the market risk, the sector risk, and the stock risk. Think about it. Just because you tell me you're super aggressive, should I hold a crashing stock? At Revere, we don't hold crashing stocks because it's stupid. Price is truth, no exceptions, period. Every security has to earn its way on our portfolio and then continue to earn its way on our portfolio. And I ask you again, Connor and Ted are 25 years old. Does your Morgan Stanley guy in the mahogany walls of Wall Street sound like them at 50? I don't think so. I'll put these guys against anybody on Wall Street. Okay? Price is truth, no exceptions. So what is the market price telling you? What is your money? What is your portfolio telling you? Folks, listen, if you want a better way to invest, or if you just want to tell a friend, a neighbor, just send them up to Revere Asset up in the right-hand corner. There's a subscribe button. This podcast will come out every Saturday morning. We record this Friday morning. Zach will have this out on YouTube by 1 or so. If you just go to YouTube and just type in Revere Asset and subscribe, our stock nerds get this for the market close on Friday in case they got to make any changes. We also do a daily market insight video every night. The market is open, telling you the short-term, mid-term, and long-term strength of the market and what we're doing in our portfolios. You want to join the Revere family and have your money managed like mine and Don's? Come join the Revere family. Folks, we'll talk to you next week on Your Money, because it's not how much you make in the markets, it's how much you can keep.